Leverage and margin. Leverage and margin are fundamental concepts in trading that allow investors to amplify their market exposure by using borrowed capital. While leverage can significantly increase potential returns, it also heightens the risk of substantial losses. Understanding how leverage and margin work is essential for managing these risks and making informed trading decisions. What is leverage? Leverage is a powerful tool in trading that allows traders to control a larger position in the market with a relatively small amount of capital by borrowing money from the broker, which increases the potential return on investment. In trading, leverage is typically expressed as a ratio, such as 10-to-1 or 50-to-1. This means that for every dollar of the trader's own money, they can control $10 or $50 worth of assets, respectively. For example, if a trader has $1,000 in their account and uses 10:1 leverage, they can trade up to $10,000 worth of assets. If the trade is successful, the trader earns profits based on the $10,000 position, not just their original $1,000. However, if the trade goes against them, losses are also based on the $10,000 position, which could lead to significant losses if not managed properly. Pros of leverage. Increased buying power. Leverage allows traders to control larger positions than they could with their own capital. Potential for higher returns. With leverage, even small market movements can result in significant profits. Efficient use of capital. Traders can keep some capital in reserve while still controlling large positions. Cons of leverage. Magnified losses. Just as leverage can amplify profits, it can also magnify losses, leading to substantial financial risk. Risk of margin calls. If the market moves against a leveraged position, traders may be required to deposit additional funds to maintain the position. Interest costs. Borrowing funds to use leverage often incurs interest, which can add to the cost of trading. What is margin? Margin is closely related to leverage and refers to the amount of capital a trader needs to deposit with their broker to open and maintain a leveraged position. Margin acts as a security deposit that covers potential losses in a trade. Basically, margin is the collateral that a trader must deposit with their broker to cover the credit risk the broker takes on by offering leverage. Margin requirements are typically expressed as a percentage of the total position size. For example, if the margin requirement is 5% and a trader wants to open a $10,000 position, they would need to deposit $500 as margin. There are two types of margin. Initial margin. This is the minimum amount of capital required to open a leveraged position. For example, if a trader wants to open a $10,000 position with 10:1 leverage, they would need to deposit $1,000 as initial margin. Maintenance margin. This is the minimum amount of equity that must be maintained in a trading account to keep a leveraged position open. If the account balance falls below the maintenance margin, the trader will face a margin call. What's a margin call? A margin call occurs when the equity in a trader's account falls below the maintenance margin level. When this happens, the broker requires the trader to deposit additional funds or close some positions to bring the account back to the required level. If the trader fails to meet the margin call, the broker may close positions automatically to protect against further losses. Best practices for using leverage. Understand the risks. Before using leverage or trading on margin, it's crucial to understand the associated risks and how they can impact your trading strategy. Use stop-loss orders. Implementing stop-loss orders can help limit potential losses and protect your capital. Monitor positions closely. Regularly review your positions and margin levels to avoid margin calls and manage risk effectively. Keep leverage low. Especially for beginners, using lower leverage ratios can help mitigate risk and prevent large losses. Have a risk management plan. Always have a clear risk management plan in place to handle adverse market conditions. Conclusion. Leverage and margin are powerful tools in trading that can enhance returns but also increase risk. By understanding how leverage and margin work, traders can make informed decisions and use these tools effectively to manage their trading strategies. However, it's important to approach leverage and margin with caution, as they can lead to significant losses if not used responsibly. With proper risk management and a solid understanding of these concepts, traders can harness the potential of leverage and margin to their advantage.